Before we begin, please subscribe to our channel for more updates on the Indian stock market. Hello everyone. Today, on August 29th, 2025, the Indian stock market had a very difficult day. It was like a game where most of the players were losing points. The main scoreboards of our market, the Sensex and the Nifty 50, both showed red numbers, which means they went down. The Sensex, which tracks 30 of the largest and most well-known companies in India, fell by 0.41% to close at 79,752 points. This might seem like a small number, but in the world of stocks, it shows that many investors were selling their shares instead of buying them. It tells us that the overall mood in the market was not very positive. The story was similar, and even a bit worse, for the Nifty 50. The Nifty 50 looks at the performance of 50 major companies from different sectors of our economy. It dropped by a larger margin, falling 0.81%, or about 205 points, to finish the day at 25,149.85. When we look closer at the Nifty 50, we see that out of the 50 companies in the index, a huge 39 of them saw their stock prices go down. Only 11 companies managed to end the day with gains. The US tariff trouble. So, you might be wondering, what was this big news that made so many people nervous? The main reason for the fear in the market came from the United States. The US government announced new trade policies, specifically tariffs. A tariff is a tax on imports. Here, the US put a very high tax on certain products coming from India. That acted like a big red flag for investors, not just in India but around the world. It creates uncertainty about international business and profits. When one country puts tariffs on another, it can lead to a trade war. That's where both countries keep adding taxes on each other's goods. Trade is crucial for an economy. Indian companies sell a lot to the US. If those products get much more expensive for Americans because of a new tax, Americans will likely buy less. That hurts sales and profits for Indian firms. When profits are expected to fall, stock prices usually follow. The tariff announcement made investors worried about future earnings for many export-dependent Indian companies. It made many traders decide to sell their positions to avoid any further risk, pushing the market indices down even more. Let's look more closely at how these new US tariffs are causing real problems for Indian businesses. The US government imposed a massive 50% tariff on certain Indian products. Imagine you are selling a handmade shirt to a shop in the US for 1,000 rupees. With a 50% tariff, the US government adds a 500 rupee tax on it. Suddenly, the cost of that shirt for the American shop becomes 1,500 rupees. This makes the Indian shirt much more expensive compared to a similar shirt from another country, like Vietnam or Bangladesh. The American shop will likely choose to buy the cheaper shirt, and the Indian exporter loses a sale. This is exactly what happened to some of our key export sectors. Shrimp industry were hit particularly hard. Textile industry were hit particularly hard. India is a major exporter of seafood, especially shrimp, to the US. It is also a global leader in making clothes and other textile products. After the 50% tariff was announced, companies in these sectors saw their stock prices fall very sharply, with some dropping by as much as 12% in a single day. Investors immediately understood these companies would struggle to compete in the American market. Their sales would go down and their profits would shrink. It's like being in a running race where you are forced to carry a heavy backpack while others are not. Companies now have to rethink their business strategies, look for new markets, or absorb costs. All painful options. While the tariffs on shrimp and textiles were already bad news, another fear started to creep into the minds of investors. This was the fear that the US might also impose tariffs on another very important Indian export, pharmaceutical products, which means medicines. The US government started a separate investigation called a Section 232 investigation to look into pharma imports. This made everyone in the Indian pharma industry very nervous. Although medicines were not included in the current list of items with a 50% tariff, this new investigation raised a big question mark about the future. The Indian pharmaceutical sector is a global powerhouse. It produces huge quantities of high-quality, affordable medicines sold all over the globe. The US is a major buyer of these medicines. If the US were to place high tariffs on Indian medicines, it would be a major blow to pharma companies. They earn a large portion of revenue from exports to the American market. A tariff would make medicines more expensive and could disrupt their business. This worry is not just about company profits, it's also about global health and potential medicine shortages. Despite the immediate worries about tariffs, it's important to understand the incredible strength and long-term potential of India's pharmaceutical industry. This sector is critical for the entire world. As of 2025, the Indian pharma industry is valued at around $58 billion. Projections show the industry could grow to about $120 to $130 billion by 2030. The long-term vision is even more ambitious, reaching $400 to $450 billion by 2047. Drivers include rising lifestyle diseases, an aging population, and more focus on holistic health. Consumers are increasingly health-conscious and treat healthcare like a consumer product. India's role in the global medicine supply chain is truly massive. To give you an idea, India supplies an incredible 40% of all generic drugs sold in the United States. And about 25% of medicines used in the United Kingdom come from India. This shows how dependent the world is on India for affordable, quality medicines. This is why, even with the fear of tariffs, many investors still believe in the long-term success of Indian pharma companies. On a day when the overall market is down, some sectors and companies get hit much harder than others. On August 29th, the top losers list was dominated by companies from the auto and IT sectors. These sectors' poor performance helped push the main indices lower. Let's look at the auto sector first. Hero MotoCorp fell 2.74%, Mahindra & Mahindra fell 2.92%, Bajaj Auto fell 2.54%. These are industry leaders. Such falls signal investor worry about future sales and profits. The IT sector also had a bad day. Many firms earn most revenue from US and Europe clients. Wipro fell 2.62%. TCS fell 3.47%. The biggest loser among large IT companies. Fears of a global slowdown and trade tensions can cut IT spending, and that showed up in these prices. The banking sector was mixed. The Nifty Bank Index closed down 0.35%. Axis Bank ended with a small gain. Kotak Bank ended with a small gain. HDFC Bank fell 1.16%, and several public sector banks also fell. Hexaware announced a strategic partnership with Replit to speed enterprise software development, a positive long-term sign. NTPC approved transferring its coal mining business to a wholly owned subsidiary, NTPC Mining, a strategic restructuring. Paytm announced leadership changes. Investors watch such updates closely for future strategy impact. Amidst all the news of falling markets, you might hear traders talking about finding breakout stocks. This might sound complicated, but the idea is actually quite simple. Imagine a stock's price has been moving up and down within a certain range for a long time. It goes up to a certain price, let's say 110 rupees, and then falls back down. This price acts like a ceiling, called resistance. The stock keeps hitting that ceiling and failing to go above it. A breakout happens when the stock price finally breaks through with strength. For example, the stock moves to 112 or 113, a signal something has changed. Criterion 1, strong buying volume on the breakout, more buyers than sellers. Criterion 2, a decisive close above the resistance level, not just a wick popping up. Criterion 3, a volume spike. The breakout is more reliable if many shares were traded. Think of it like a door. If many people push together, it opens and stays open. But breakouts can be tricky. False breakouts happen when price pops above and then plunges back. This can trap traders and cause big losses. So successful breakout trading is also about risk management, stop losses, position sizing, and confirmation. Traders scan multiple charts for candidates and wait for the right setup. Remember, trying to buy breakout stocks in a strong downtrend is like swimming against a current. It's much harder to succeed in a falling market. When the market is volatile and unpredictable, the most important skill is managing risk. Risk management means protecting your money from big losses. It's like driving. You use the accelerator, but you also use brakes and seatbelts. One key tool is the stop loss. Set a level to automatically sell if the trade goes wrong. Another is position sizing. Never put too much capital into a single idea. Diversify. For example, buy a breakout at 112 with a stop at 108. A small defined loss protects capital. This approach lets you survive another day and trade another opportunity. Always align trades with the broader market trend. Trading breakouts is harder in a falling market. So, know the macro risks, wait for confirmed breakouts, and always manage risk.